Hey, Dave, I wanted to put together a little presentation for you to help you or to give some insight into more of the way that I view the stock market, just to give you some clarity on that point of view. So I look at I kind of take maybe a bigger picture, and I don't necessarily just look at the stock market, but I look at basically the four major asset classes that someone can invest their money in on planet Earth. And it's not necessarily has to be stocks, but I know you do private equity, so this really should probably say companies, public and private, but I'm calling it just stocks for the sake of the people that hire me. But you basically can put your money in the stock market, you can put your money in the bond market, you can put your money in the physical asset market, which could be split between real estate and commodities. And then you have the currency market. And most people don't think of themselves investing in the currency market. And I don't mean trading currencies, but anyone who's paid in US dollars and saves that money in US dollars is directly investing in that currency, US dollars. So a lot of times when people take their money out of the stock market, they don't see it as selling the stock market and buying a currency. They just see it as selling the stock market and setting aside. But there's actually no such thing called setting money aside on this planet. So the question that I just wanted to figure out was, of these four asset classes, is there a way to know what probability, or is there a probability that says one of these asset classes will do better than others over a set period of time? And so I really started looking for a relationship between any of the assets, almost like two runners going around a track and looking to see which runner has the baton, whether it was the stock runner or the non-stock runner. That could be the bond runner, the physical asset runner, or the currency runner. So again, I approached this when I was in my 20s, so I didn't have a lot of known bias. I just wanted to know what really worked. And one of the things that hit me a lot when I talked to people in the industry was they just said how random everything was, and that you couldn't really do anything about it. So just diversify. And they always talked about how they had to do a lot of things to grow and protect the money. And it just seemed like there was a lot of complication for complication reasons. Didn't really seem like the complication was helping. But two of the main themes coming out of conventional advisors' mouths were lots of randomness out there. Don't try, just be safe and diversify. And it's really, really complex, and you got to do a lot of things. So just let us do that. But in my research, I actually did not find that to be true. I mean, yes, it's a very complicated system looking at a GDP or looking at a stock market. But if you were to start to look at long periods of the stock market, you'd start to see cycles. And when I started looking for cycles, some of the first ones I actually saw were sunspots. I know it sounds weird, but sunspots run in cycles, and that's the price chart you see on the screen. And then I came across ice core samples. This price chart goes back 450,000 years of ice core samples, and it shows how the Earth's temperature changes over time, which is very interesting. And my brain sees cycles in this. It does not see randomness. And the most obvious example of cycles is just you have spring, summer, fall, and winter, and those are cycles. So my assumption was if there's cycles all over nature, there's probably cycles within the stock market. And one of the first cycles I saw just happened to be the cycle between gold or stocks. And this is a price chart of gold going back 116 years. And basically when the green line is going up, that means it's better to be in gold than stocks. And what that means is gold will actually protect and grow your money better than stocks. But there are periods of time where gold is actually something you would not want in your portfolio because stocks outperform gold. So when my brain looks at this, it sees this relationship between gold and stocks, and it looks like a repeatable pattern to me. But it's not just gold and stocks. I found these kind of relationships between a lot of different asset classes, and gold would be an example of a physical asset. The same thing happened between stocks and bonds, and this is a price chart of the Dow Jones going back to about 1910. And I just put in little arrows here just to kind of point out there are periods, basically two main cycles in the stock market. One cycle is where the stock market actually goes up over a set period of time, and that average length of time is about 17 and a half years. But then there's periods of time where the market, adjusted for inflation, goes sideways to down. And in those periods, in this case, the red arrow, bonds do really well and gold does really well. Now, I know your position on bonds. This isn't about saying what you should or should not do. I'm simply pointing out that there's these relationships, these cycles that go on that can increase the probability and the safety of protecting and growing your money. This is not about high risk trades, high risk investing. It's not about day trading, getting in and out. Just looking at the cycle of something like an epidemiologist would look at the cycle and patterns of disease to help manage and eliminate disease. A financial epidemiologist, which I know there is no such thing, would look at the cycles and the patterns of the stock market to help protect and grow people's money. So the screen here, you have this 115 years of data where there's this repeatable pattern where sometimes stocks greatly outrun bonds or gold, or just the opposite. And what lies underneath this is how hundreds of millions of humans are behaving with their money in the stock market. So it's not acting on just one person. And you have, over a century of data. So lots of good and bad things have happened within that century plus in this country. And then the last one, and I said this to you on the phone, people often believe that you should be diversified. And one of the main beliefs under that is you should have your money in international, a portion of it at all time because it's safer. But if you look at this price chart, and this is comparing international stocks with U.S. domestic stocks, when the blue line is going higher, and I highlighted it with the green arrow, all it's saying is U.S. domestic stocks are going to outperform international stocks during that cycle. And there is no predicting. There is an easy way to tell when there is a high probability of a kind of the baton getting handed off between one runner or the other. But the point is that if you have exposure to the international market while international stocks are clearly underperforming domestic stocks, it's just a form of a tax. It's something that doesn't have to be there, and it just slows down the growth of someone's money. It slows down the protection of someone's money. It's not about doing something more dangerous or more speculative. In fact, it's just the opposite. So the way I look at diversification, or what I call conventional diversification, is where someone's like, you got to have large cap and small cap and growth stocks and international stocks and mid cap stocks and value stocks. But look, they're all in the same bucket. They're all on the same boat. So if that boat hits something, everything goes down with it. And I'll show you this information in a slightly different way. I call this my grandma's quilt, this next picture. And I know this is not a normal way to position data, but if you just look at the red line's halfway. So there's 5 sectors below and there's 5 sectors above that red line. And these sectors are REITs, emerging market, international stocks, small cap, large cap, mid cap, cash, bonds, commodities, and inflation protected treasuries. The point is that those yellow boxes, which in this example say large cap, is really the S&P 500. And sometimes the S&P is above the red line, sometimes it's below the red line, but the point is you're getting at least about the average of all of that stuff, and having to complicate your portfolio by being diversified over 10 asset classes that get rebalanced is a form of creating complexity for complexity's sake. So I say to anyone, for anyone who just wants to kind of keep with the market, just buying the S&P and reinvesting in dividends is going to beat 98% of all big box money managers, boutique money managers, independent advisors, because most of them are just trying to stick to, their index. So just want to show you a point here. When things fall, when the stock market falls, it pulls everything with it. Back in 2011, the market fell about 19 or 20%. And I just want to see what happened with main sectors, different assets before and after that fall. So this is 1 year before that 19% fall in 2011. And those 6 squiggly lines represent the S&P 500, international stocks, dividend-producing stocks, deep value stocks, small cap stocks, and large cap value stocks. And the red dot over to the right, that's literally just showing you where the S&P 500 is with reinvested dividends. It's right in the middle of the pack. Like, yes, some will underperform, some will overperform, but just buying the S&P and reinvesting dividends gets you in the middle of the pack. And then the 2011 correction, fall, market sell-off, whatever you want to call it, happened. And, there's the S&P it's a little bit better than being in the middle. But of those 6 completely different asset classes, the S&P kind of holds about in the middle, meaning diversification is not helping during market corrections. And then I wanted to just see what the S&P with reinvested dividends did 1 year after a noticeable correction. In this case, it was the almost 20% correction in 2011. And again, the S&P is right here. There's 6 different asset classes. It is the third from the top and not far below the top. And so, this idea of diversifying to protect the downside, that's not what diversification does. It doesn't do that. And it doesn't actually even help in the stable uptrends, because then you have, half your assets are slowing down the growth and the other ones are growing faster. But what you end up getting is, again, the S&P with reinvested dividends. So diversification doesn't help. And one of the reasons it doesn't help is because when the S&P falls, the correlation of stocks in the S&P 500 or in the stock market, it doesn't matter what index you look at, it goes close to 1. So as, the S&P goes, so does everything else. And there's really no way around that. And this correlation goes up even more during all kind of the red arrow sections where the market is going sideways or down. That correlation between the movement of the index to the stock market, overall stock market, that correlation goes up even more. And then this was the 2008 correction. Large cap stocks, international stocks, dividend producing stocks, small cap stocks, mid cap stocks, international stocks. Look, they all fell. They didn't all fall 58%. They fell somewhere between 54, to 59%. So, you'll get a little diversification, but it's not going to protect you from the corrections, which was one of the main things I noticed, that if diversification is not going to correct or save or protect your money from the corrections, then it's not helping on the downside. And I saw that it doesn't safely accelerate your money to the upside either. And I went through, I looked at 2011 and 2008. 2009 went all the way back, 87, 1980, 73, 1968, 1965, 61, 56, 46, 39, 37, 1929. And what I looked at and noticed was these cycles repeat themselves. When there are large market sell-offs, diversification does not help. And when the market's in a stable uptrend, which it is, 78% of the time, it doesn't help either. And that's why I often talk about why diversification is a myth. Okay, thanks, Dave. I hope this helps. I will reach out to you in a couple weeks. And if you have any questions, give me a ring and we can connect. All right, thanks.